Hello everyone, welcome back. We have discussed so far the current account deficit in the balance of payments. Let's now discuss the financing of the deficit. Well, first of all, globalization increases complexity due to the integration of economic and financial systems. You know that. Growing complexity poses a severe challenge for risk management in a world where developed and developing countries compete for expanding trade market shares and for tapping capital markets. Regarding countries with balance of payments deficits, the issue is to shrink the deficit, of course, without killing its economic growth. And in the meantime, the challenge is financing the deficit without increasing the external debt excessively. Since the collapse of the Bretton Woods Agreement back in 1971, the US deficits have become larger and larger, and they get financed by the accumulation of dollar assets by those countries which export goods and merchandises to the US, namely China, Germany, Japan, and Korea. Now, the deficit, as you can see, is slightly lower since the global financial crisis, due not only to a decline in imports, but also thanks to the drop in oil prices since mid-2014, and also thanks to increasing services revenues. Well, once a country has a current account deficit, it can, and sometimes it must, shrink it. Now, that will take some time, as we have seen previously. But in the meantime, it must finance a deficit by attracting capital inflows. So far, so good. The US has not met major challenges to finance its growing deficit, thanks to China, Japan, and South Korea. And the mirror image of the US deficit is a mounting public debt that today reaches around 110% of the US GDP. But the issue is not so much the amount of deficit financing, but the challenge of sustainable financing. And that requires looking closely at the composition of the financing regarding maturity, that is long-term, short-term, the interest rate, fixed, floating, and the nature of financing, public versus private, official, multilateral, private banks versus capital markets, bonds. The capital account will record the financing of the deficit, starting from the less liquid items, that is FDI and portfolio capital flows, down to the more liquid financing items, that is short-term capital flows. If there is a residual financing gap, then reserves will drop, or payment arrears will increase, or exceptional financing will come from the IMF. The table of users and sources will list on the one side all revenue and capital inflows, and on the other side all the expenditures and capital outflows, hence focusing on the financing gap that must be met by the country depending on its creditworthiness and its global market access. Capital inflows will come, as I said, from public and private sources, and the nature of the type of financing will have short and long-term consequences on the country's debt structure, as well as on the country's external debt indicators. FDI, foreign direct investment, has not the same consequences, of course, as trade credits and bonds. FDI is clearly the preferred financing strategy, given that it's a win-win strategy for the country. FDI contributes to boosting jobs, domestic production, productivity, taxes, domestic employment, without increasing the external debt. In the meantime, there is an asset shift, of course, from domestic to foreign shareholders, including within the framework of privatization programs. If FDI alone cannot fill the financing gap, well, the country must tap global capital markets. Hence, its debt will increase. But watch out. All depends on the type of financing sources, long, medium-term, short-term, that is more or less volatile sources of capital inflows. An unfunded financing gap will lead, of course, to a reduction in the country's official reserve assets of the central bank. Reduction in reserve assets is a financing item in the balance of payments, and the reserve variation will show up with a plus sign, a positive sign, like any other source of capital inflows. So let's keep in mind, a plus sign in the balance of payments means a financing flow in the capital account, i.e. a decrease in the stock of reserves. Now, how long can a country sustain reserve reduction? Well, the country risk analyst must zero in on the deficit as well as on the ratio of reserve to imports. And for how long can this ratio decrease? In the balance of payments, a surplus is a flow of resources, and the accumulation of surplus leads to increasing reserves that constitute a higher stock of assets. No surprise then that China's reserves show an impressive increase between 2000 and 2015, reaching today around $3,700 billion, roughly 1/3 of global reserve assets, and slightly decreasing since 2015. Now, what to do then with these large and growing reserves? Well, it's typically an example of recycling story. Roughly 1/3 of China's reserves are invested in US government securities, treasury bonds, helping to finance the US deficit, hence reducing the cost of deficit financing and supporting the strength of the US dollar. However, China reduced its exposure to US securities by roughly $100 billion between mid-2016 and mid-2017. Last but not least, the so-called errors and omissions stem from statistical gaps in recording balance of payments data, but also capital flight, hence an early warning indicator of upcoming country risk volatility. Each and every country, including France, the US or Zimbabwe, has errors and omissions in its balance of payments. But large and growing discrepancies are a source of concern, hence reflecting capital flight and exchange rate imbalances. Look at Russia, for example. Each time you have a devaluation of the currency, the ruble, you have capital flight. Each time you have a drop in gas prices, or each time you have political tensions, capital flight increases as indicated in larger errors and omissions, but to the tune of $15 or $20 billion per year. Well, when all the financing sources are exhausted, there is one residual source to close the financing gap, and this is exceptional financing from the IFIs, and mainly from the IMF. And the financing will come with a program of austerity. In times of crisis, the IMF credits increase, and in times of global economic growth and prosperity, repayments to the IMF increase, keeping in mind that the maturity profile of the IMF credits is short-term, not long-term like the World Bank, up to 20, 30, or even 40 years. The up and down waves of IMF financing gives you a short story of global crises since World War II, and mostly since the IMF stepped in to meet countries' financing gap in the mid-1980s. IMF credit outstanding plunged just before the global financial crisis, up to the point that emerging market countries used their liquidities to repay the IMF in advance, including Russia and Venezuela. Clearly, with the fall in energy prices since mid-2014, that looks like shooting from the hip. Well, all in all, market access and credit worthiness are necessary to finance a sustainable deficit. Success depends not only on the overall volume of capital inflows, but on the structure of capital inflows: maturity, creditors, currency, interest rates. A sustainable deficit fully depends on sustainable financing, and that should be the focus of country risk analysts and country risk managers. Thank you.